Hello and welcome back to the lesson. We are going in today's lesson to discuss the development of the overall audit strategy. That is the objective of our today's lesson. By the end of the lesson, you should be able to discuss the development of the overall audit strategy, which is a crucial phase in audit planning that establishes the scope, 1, timing, 2, and direction of the audit. So candidates, anytime you are asked to define an audit strategy, make sure that the terms scope, timing, and direction come out of your definition. And an audit strategy is a high-level plan which is an iterative process. It is an iterative process. That is to mean that once an audit strategy is developed, it's not final. An iterative process is a process that involves repetition, doing something again and again with the view of improving it or making it perfect. So once an audit strategy has been developed, before the commencement of an audit, it's not a final plan, but it may change as new information emerges or as new changes happen. For example, we'll be learning later of what we call the impact of material misstatements at various stages in the audit. Because candidates, after embarking on an audit, or before embarking on an audit, the auditor has to develop an audit strategy. And for instance, the auditor may set a lower level of materiality based on the information the auditor has on the state of the internal controls of the company. So if the internal controls of the company are very strong, the auditor may set a lower materiality level. But in the process of conducting the audit, the auditor may discover a material misstatement in the financial statements of the company. And that will then cause the auditor to revise the audit strategy, because there are various consequences or impacts of material misstatements at various stages of the audit. It could be at the planning phase or even during the audit. So that's what we mean by iterative, right? Developing an audit strategy is an iterative process that considers the understanding of the entity and its environment, including internal controls, in order to arrive at an effective and efficient approach. So the auditor has to understand the company so that it can come up with an approach. What approach is the auditor going to take in the process of auditing a company? That has to be determined beforehand. And the overall audit strategy, which is a plan, sets the tone for the entire audit engagement. It sets the tone. It sets the tone. All right? And it is because of that tone that the audit engagement will roll out. And it is essentially a high-level roadmap. It is a high-level roadmap that outlines how the audit will be conducted to achieve its objectives. So thus, we need to have that understanding of what an audit strategy is. Okay? It is a high-level plan. And it is out of this audit strategy that an audit plan is developed. So in this lesson, we are going to discuss some of the key aspects of the development of an overall audit strategy, because it involves addressing key areas in an audit which are also interrelated. You understand? Overall audit strategy. So in this lesson, at the end of this lesson, candidates, you are expected to gain the understanding of the various aspects when it comes to development of an audit strategy. So there are key areas in an audit, starting with the understanding or appreciating the scope of the audit. We have aspects like the timing of the audit, their approaches of the audit. Those are key areas. Audit, gathering of evidence. Another aspect or step in an audit is generating an audit report and so on. So we want to gain an understanding of all these key aspects when the auditor is at the point of developing an audit strategy. You understand, candidates? So we are moving into the key aspects. One such aspect, as I mentioned just briefly, is the scope of the audit. One, scope of the audit. So when developing the audit strategy, the auditor has to know the scope of the audit, And how does the auditor know the scope of the audit? If you are called upon to audit company A, okay, you have to, in your audit strategy, put down or understand the audit, the scope of the audit. To what extent are you going to audit? And for you to be able to understand that, you may need to refer to for instance, the financial reporting framework. One way to identify the scope of the audit of the company you are auditing, you may be assisted greatly by making reference to the financial reporting framework. Financial reporting framework. Because an audit has to be conducted in accordance with the applicable financial reporting framework. As an auditor, therefore, when developing an audit strategy, you have to identify the applicable financial reporting framework. It could be, for instance, the International Financial Reporting Standards or the generally accepted accounting principles, or it could be any other financial reporting framework. What framework? The scope may also be determined by statutory provisions, okay, or what we call statutory and regulatory requirements. Statutory and regulatory requirements. As an auditor, you don't determine the scope of the audit the way you want. You don't decide. No, auditors are guided by laws. So as an auditor, you have to understand any specific statutory or regulatory requirements that impact the audit. We may have, for example, specific industry requirements. If it is the financial services industry, we may have the Central Bank of Kenya having regulations on how audits have to be conducted. If it's an NGO, we have also requirements in that area. If it's a private company, we have the company law. All right? So you may have company law requirements. We know the company law has provisions on audit. So before you engage on conducting an audit, at the phase of developing the audit strategy, make reference to any statutory or regulatory requirements of that you as an auditor are required to meet when developing the scope of the audit. The scope of the audit may be determined by statutory or regulatory requirements. Then there's also another important aspect when determining the scope of the audit, which is the reporting objectives. The reporting objectives may also determine the scope of the audit. Reporting objectives. Reporting objectives. What types of reports are required? For example, it could be an audit report on financial statements. It could be a report on internal control, or it could be specific regulatory reports. Each industry may have requirements on reporting. So the reporting objectives may also determine the scope of the audit. The scope of the audit may also be determined by locations. Locations of operations. Locations of operations. If the client has multiple locations or multiple branches, deciding which locations require physical visits and the extent of audit work at each branch. So the scope of audit of a company that does not have any branch and the scope of audit of a company that has 15 branches cannot be the same. The scope will be wider if the company has multiple locations of operations, and which locations may require the auditor to pay visits, physical visits. So when developing the audit strategy, first of all, determine the scope of the audit, which may be determined by locations of operations. Another factor that determines the scope could be components and consolidated financial statements. Components and consolidated financial statements. As an auditor, when developing the audit strategy, you have to determine whether the audit covers only parent company statements or consolidated statements or individual components. So all this will determine the scope of the audit. To what extent are you going to carry out the audit? Then we have 6 period covered. The period covered by the audit can also determine the scope of the audit. As an auditor, you have to clearly define the financial period to be audited. All right, it could be 1 year, it could be interim audit, it could be whatever period that is required. That period will determine the scope of the audit. So the scope of the audit is a very key component or aspect of development of audit strategy. So first of all, you have to come up with the scope of the audit when developing an audit strategy. Then there is timing. Number 2, the timing of the audit. The timing of the audit is a key aspect when developing audit strategy. Timing of the audit. Timing of the audit. Timing. Now, timing may be influenced by various aspects or things, e.g., reporting deadlines. There are deadlines to which the reports have to be submitted. That will determine the timing of the audit. Reporting deadlines. And when developing an audit strategy, the auditor has to consider internal and external deadlines for financial reporting and audit completion. That will help in development of the audit strategy. Reporting deadlines. Then you have to check if there are any key dates. Key dates. And how are key dates important? when developing the audit strategy. It's important, candidates, that the auditor identifies important dates, for example, for inventory counts, for board meetings, and other significant events. All right? Inventory counting is that is a key event. So when developing an audit strategy, that has to be made reference to, because the auditor may be required to attend the event. So it's important when planning that the key dates are identified. Do you understand? Board meetings and any other significant events. Companies have significant events which impact an audit, which may help the auditor even gather evidence. So it's important that the auditor also pays great attention to key, important, significant dates and events. 3, interim versus year-end. You have interim and versus year-end work. That will determine the timing of the scope or the audit strategy. Timing, that is interim versus year-end work. There is work that may be conducted in the interim. There is also audit work that should be conducted towards the end of the accounting period. So the auditor has to decide what audit procedures can be performed at the interim stage. That is before year end. Interim stage is before year end, in order to improve efficiency, such as control testing or substantive procedures on predictable transactions. So the auditor has to decide what procedures can be performed when developing the audit strategy. This is done, candidates, before the auditor begins the audit work. The auditor has to determine what kind of procedures will be conducted in the interim, or what procedures will be conducted at the year end. That has to be determined in advance. When you considering timing of the audit as a key aspect of audit strategy, another aspect is the availability of the audit team members. And not just the team members, but the client. So let me say team and client availability. So at the audit strategy development phase, the auditor has to know in advance what time, because we are discussing timing, what time will be client available. Also, when the auditor has to have meetings with the client company's management team or board of directors. So before starting the audit, the auditor has to know in advance when will be the client available. The auditor has also to check if the audit team members will also be available during that period of audit. Because it's possible to take up an audit engagement, but the team members could be handling another engagement, could be employed in another engagement. So timing, team and client availability, very important. Understand? That means scheduling the work to align with the availability of both the audit team and the client. So that's all we can say in regard to timing of the audit, which is a key aspect in development of the audit strategy. Another key aspect is direction of the audit. Direction of the audit. At the beginning, I told you, candidates, when defining audit strategy, make sure you don't forget scope of audit, timing of audit, and direction of the audit. The three defines what an audit strategy is. So when developing an audit strategy, there is that aspect of direction of the audit. What are the key audit areas and focus? Direction refers to focus, direction. So, for example, candidates, when you are visited a new location, for example, you have come to Nairobi for the first time, and you are asking people on the road for location of the manifested publishers headquarters. You may meet someone and that person may guide you by pointing. That is the direction. So direction refers to the focus. Okay, what areas will the auditor focus on? Will the audit focus on? What will be the key audit areas? Right? And such key audit areas, candidates, when developing an audit strategy, is what we call materiality. At this phase, the auditor has to determine what we call materiality levels. Materiality levels. That means determining overall materiality for financial statements as a whole and performance materiality for specific accounts or classes of transactions. You understand? Because after determining materiality levels, then that will guide the scope and extent of audit procedures. Materiality. Then we have what we call risk assessment. Very important, candidates. Risk assessment. At the phase of developing the audit strategy, there has to be assessment of risk. Risk assessment. And as we learned in other chapters, risk is in three categories. We have the inherent risk. There is also the control risk. We have other risks like fraud risks and so on. And perhaps, candidates, risk assessment is the most critical input to the audit strategy. It's the most critical. Everything hinges or depends on the level of risk or risk, candidates. So, based on the understanding of the entity and its environment, including internal controls, the auditor identifies and assesses one, inherent risk. The auditor has not only to assess, but to first of all identify if there are any inherent risks. These are risks of material misstatements due to the nature of the business or nature of transactions, assuming no related internal controls. These are risks that will arise just because of the nature of the business. We have very sensitive businesses like the banking business and business that deal mostly with the cash. We have also companies that are highly computerized systems, complex systems. Such companies have what we call inherent risks, which are risks of material misstatements due to the nature of the business or the nature of transactions. There could be risk of material misstatements just by the fact that the business is of a certain nature. The transactions are of a certain nature, which inherently, without considering internal controls, such businesses are risky. So that has to be determined when developing the audit strategy. Apart from inherent risks, we have control risks. Control risks. Now, control risks, these are risks that a misstatement that could occur. It is a risk that a misstatement could occur which will not be prevented, detected, or corrected by the entity's internal controls. We know that companies put in place internal controls, and the purpose for having internal controls is to prevent misstatements or fraud, or to detect if prevention is not possible, and if it is detected, then correction is done. So control risk is the risk that misstatements that could occur will not be prevented. You understand? So when developing an audit strategy, the auditor has to assess such risks. So we have control risk. There's also fraud risks, candidates. Fraud risks have to be assessed. Fraud risks. These are specific risks of material misstatements due to fraud. So in determining the direction of the audit, materiality, very important. Risk assessment, perhaps the most important. Then we have the what we call the audit approach. The audit approach will determine the direction of the audit, or the direction of the audit determines the audit approach. So after identifying materiality and also assessing the risk, then the auditor can develop or come up with an approach when also developing the audit strategy. If internal controls are, for example, assessed as weak or inefficient to test, the auditor will rely heavily on substantive procedures. So we have substantive approach. So there are various approaches. One is substantive approach. So after assessing the control environment, the auditor will be able to know whether the internal controls as put in place by the company are strong or weak. If the internal controls are weak, then the auditor will choose the substantive approach when auditing the company. These are tests of details and analytical procedures. Substantive approach involves test of details. The auditor will carry out substantive audit procedures because the internal control system is weak. If the internal control system is weak, then there are high chances that there are material misstatements in the financial statement. So the auditor may not rely on internal controls, which will prompt the auditor to come up with a different approach we are calling substantive approach, which is a test of details and analytical procedures to gather sufficient appropriate audit evidence. But if the controls are strong, then the auditor can rely on the internal controls. Then the auditor's approach will be what we call reliance on controls approach. Reliance on controls approach. If the internal controls are strong, okay? If the internal controls are strong. If internal controls are assessed as strong and effectively designed and implemented, the auditor may decide to test the operating effectiveness of controls. And if controls are found to be effective, the extent of substantive procedures can then be reduced. The auditor will not rely on substantive procedures because the controls are strong. And this is generally more efficient for larger, well-controlled entities. If the entity is large, then the auditor cannot carry out substantive approach because the transactions are voluminous. The auditor may not have the time to carry out substantive tests. But if it's a large company and the controls are effective, then the auditor can rely on controls approach. Then there may also be a hybrid of these two. Number 3, combination. Combination of the two. Right? Most audits involve combination. A combination with varying degrees of reliance on controls depending on the specific account or assertion. So depending on the assertion, depending on what has been presented in the financial statements, the auditor can apply these two. The auditor may decide to, maybe when it comes to auditing inventories, to employ the substantive approach. But when it comes to, say, payables, the auditor may rely on company's control. So there is another approach where these two may be also applied. The approach can constitute both substantive approach and reliance on controls approach. So that is we are discussing, that is the C. Okay, still under direction candidate. This is ABC: materiality, risk assessment, audit approach. Then D, there is what we call key audit areas. Key audit areas will determine also the direction of the audit. Key audit areas. Key audit areas. Key audit areas. Now, the auditor in developing an audit strategy has to identify specific accounts, disclosures, or areas of the financial statement that are deemed to be of higher risk or deemed to be of complexity and therefore require more audit attention. For example, we may have revenue recognition, it could be inventory valuation, significant estimates, it could be related party transactions. Those could be key areas, key audit areas. So when developing an audit strategy, the auditor has to identify the key audit areas, because that again will determine the direction of the audit, what to focus on while auditing. Then lastly, direction of audit will be determined or may be determined by the significant accounts and disclosures. Significant accounts and disclosures. That means when developing an audit strategy, the auditor should determine which financial statement accounts and disclosures are significant enough to warrant detailed audit attention based on materiality and risk. Here we are talking about the assertions in the financial statement. We have the assets, liabilities, and capital items. Assets, these are fixed assets, current assets. We have liabilities, long-term liabilities, short-term liabilities. The auditor should identify significant accounts and disclosures. That's the third aspect. The fourth aspect in development of audit strategy is resource allocation. Resource allocation. Allocation of resources. When developing the audit strategy, resource allocation is a key component. And one resource is the audit team. The auditor, before commencement of an audit, the auditor is required to allocate resources. And one such resource is the audit team. This is what we call audit team composition. Audit team composition. The composition of the audit team that will carry out the audit. The strategy should determine the size and composition of the audit team, considering their necessary experience, expertise, and also seniority required for different areas of the audit. The audit may require IT experts, it may require valuation experts, and so on. So that has to be determined when developing the audit strategy. 2, budgeting. Budgeting. That means estimating the resources like the hours, the money or the budget that is required for the engagement. Then there is also allocation to areas. There are some areas that require huge amount of resources, others may be minimal. So the auditor, when developing the audit strategy, has to assign specific team members to key audit areas based on their skills and assessed risk. That has to be done before the audit is commenced. Aspect number 4 of the audit strategy. Then, of course, lastly, we have the reporting objectives and communication. Reporting objectives and communication is a key aspect of development of audit strategy. The audit report has to be planned. It has to be planned audit report. It has to be planned. The auditor has to determine the nature and timing of reports or other communications that are required, including the audit report, including management letters, including communication with those charged with governance. At the end of the audit, all that has to be done. And before the audit is commenced, that has to be planned. When will the management be met? When will the auditor issue the report? And so on. Planned audit reports. There are various reports that may be required to be generated at the end of the audit. 2, we are talking about communication. Other than the reporting plan, there is also communication plan. When developing an audit strategy, the auditor has to develop what we call a communication plan. The auditor has to establish how and when the audit team will communicate with the client's management. When the audit team will communicate with the audit committee and any other relevant parties. That has to be planned in advance in an audit strategy, communication plan. You understand? So that's it, candidates. When developing an audit strategy, these are very important aspects. 1 is scope of the audit. 2, timing of the audit. 3, direction of the audit. Scope, timing, direction. Put that at the back of your mind if you are going to sit for exams. If you have any queries or questions that will be examined on audit strategy, these are very critical aspects of audit strategy. Then this is 3. Then number 4, we have resource allocation. When planning, an audit cannot be effective where resources are not properly allocated. Then lastly, reporting. There has to be a reporting plan and a communication plan. So when developing an audit strategy, candidates, now you know if you are to be engaged somewhere to audit financial statements, then you have to come up with a high-level audit plan we are referring to as the audit strategy. So after developing the audit strategy, then we have what we call output. What is the output of all this effort? The output of this phase is typically a formal document or series of documents that outlines the decisions made regarding all these aspects. There will be communication regarding scope of the audit, timing of the audit, direction of the audit. That will be the output. And this document will serve as a reference for the audit team, and also it may provide a framework for the development of the detailed audit plan. So this is an overall audit strategy, which is general. It's a general plan. This general plan is what is the word? It is implemented through an audit plan. After the audit strategy, then the plan will have details of what will happen, the procedures that will be followed when conducting the audit. The word I'm looking for is operationalization. It is the audit plan that operationalizes the audit strategy. So do you understand? So this will serve as a reference point when developing the audit plan, which is more detailed. Okay, this is just a high level. It is developed by the top honchos in the audit firm, but the plan will now flow from this audit strategy. And just quickly, one may ask you, what is the importance? If you're asked, what is the importance of audit strategy? What will you say? Out of what we have discussed, what do you think can be cited as the reasons why developing an audit strategy is important. One thing that should quickly come to your mind is efficiency. Efficiency. An audit strategy helps to focus audit efforts on the most critical areas, which avoid unnecessary work. You've seen here, we've said that the audit may, in developing the audit strategy, the auditor has to identify key audit areas. So when you focus on key audit areas, then you avoid unnecessary work, which leads to efficiency. Related to efficiency is effectiveness. Number 2, effectiveness. That's another reason why the audit strategy is important. It ensures that the audit addresses all significant risks of material misstatements, and that's what we talked about here. Okay, it leads to effectiveness. All audit areas or significant risks are addressed. Then we mentioned guidance. It is a guide to development of an audit plan. It provides clear direction, because we are talking about direction. It provides clear direction to the audit team, ensuring consistency and coordination. 4, resource management. Resource management. The audit strategy facilitates proper allocation of resources, because in point number 4, there is the aspect of resource allocation. So it facilitates proper allocation of resources. Then 5, we can discuss adaptability. Now, while an audit strategy is a high-level plan, it is also flexible enough to be modified if circumstances change or new information emerges during the audit. That's why at the beginning I did mention that development of the audit strategy is an iterative process, meaning that it is a repetitive process. It's not cut in stone. It is repetitive, where the auditor may need to change what he had planned initially to accommodate new information or anything that was not anticipated when developing the audit plan. Adaptability. That's the meaning. So as we are closing, it's important for you to remember that the overall audit strategy, the development of an overall audit strategy, is dynamic and should be updated as needed throughout the audit. You don't develop an audit plan and you go to sleep. No, you have to be very cautious. You need to be alert to any changes that may come out, particularly if significant changes occur in the client's business, or if there are any changes in the environment. There could also be new risks that are identified as the audit progresses. And it is also a fundamental step. Development of audit strategy is a fundamental step in ensuring high quality and efficient audit engagement. So that's the end of our today's lesson on the development of the overall audit strategy. If you have any questions, please, you are free to send your questions. Below this video, there is a comment section where we address all your questions. That is the end of the lesson on development of audit strategy. Bye.